faster with Apple Pay, a safe, contactless, easy way to pay. Being a small business owner can be tough. As a small business owner, I always look for better ways and solutions to help me increase my sales, get more customers,
Good morning, everyone. How is everyone doing? My name is Jeff. I'm from AmEquities. I want to wish you all 恭喜发财 and a new lunar year. May a good fortune and a more prosperous for everyone. Okay, in this session, everyone is free to ask the question by typing the chat box below. But to avoid disruption, speaker will only address your question at the end of the presentation. Please let me introduce our speaker for today. Mr. Lew is the head of retail research at Equity Research and Equities. He has over 10 years of experience in analyzing various financial instruments, including stock, indices, futures, and commodities, focusing on the technical analysis and growth in investing strategy. He holds a bachelor degree in economics and finance, as well as an MBA from Australia RMIT University. Presently, he also holds a chartered market technician professional designation. So without further ado, let's all welcome the only Mr. Lew here. Mr. Lew, the mic is yours.
Thanks, Jeff. Good morning, guys. Happy New Year. Thanks for joining for this Saturday event. So for today, basically just a brief outlook about what's going on to the market outlook. I'm Chee Hao. I'm the head of retail research under Equity Research and Investment Bank, one of the analysts among the team. So today, just run through the slide and hope you guys can get some insight from the market. So basically, I always like to start with the macro view. So basically, we start off like in an investment team, research team, we have economics team, we have equity teams. So for macro outlook, usually done by our economics team. So basically, we start off the GDP growth for this year. We are expecting in 2023 GDP growth will be 4.5%. Compared to last year, we are estimating 2022 is 8.5 to 9%. 8.5% or 9% in 2022 basically come from the lower base, and because the year before, previous year, we have a lockdown MCO. That's why last year we have a good run 8.5% to 9%, but this year we are estimate on 4.5%. Even though it's lower down from 8.5%, but 4.5% for 2023 GDP growth actually is much better compared to other countries, especially Eurozone, US country. One of the reasons is we think we still have a very resilient domestic demand and consumer consumption, private consumption. All this will push the GDP growth. OPR rate, as for now, we are maintaining on 3% this year. Even though the latest they didn't really raise the OPR rate, it's still maintained at 2.75. But our economists think that on this year, we still have one rate hike and another 25% up to 3%, which is a pre-COVID OPR rate. Some of the upside in Malaysia, why we think that we still have a GDP growth around 4.5%. Firstly, one of the reasons is tourism. Even last year, actually, we have an inbound tourist, which means after a lockdown, people start to ongoing to interstate travel, continue to boost the tourism for our local. Not only that, this year, as you read from the news, from the media, actually China is reopening after 3 years. So we strongly believe that for this China reopening, basically will bring out and boost our local domestic. This is one of the boosts for the GDP. Besides that, labor market. This will follow us as last year we have a very tight labor market. So everywhere you heard before, there's a shortage on the laborers, even the talent shortage, even the mid-level is shortage labor market. But this year we see the condition is getting improved and getting better wages. So hopefully this will boost the manufacturing, give our PMI level better in Malaysia. E&E sector, if you take a quick look on my pointers, basically E&E is always Malaysia one of the main export product. So E&E on is up around 38.1%, followed by ONG, which means the oil and gas product, then followed by palm oil. So E&E is always still the main product that boosts our GDP growth by export. Even though last year we have a correction on E&E, but we still believe that it's just a correction. Eventually, the mega trend is there. E&E product is still sustainable because the EV is upcoming. renewable energy is upcoming. So E&E product definitely will continue to be robust. It's just a temporary step down. Investment, we start seeing FDI and DDI coming in after we have a new utility government. So basically, investment coming back to Malaysia, actually we see a positive compared to the year before, the year and the COVID year. Private consumption, as I mentioned just now, we continue to see an improvement in job market. So with private consumption, that's actually will boost the GDP as well. So all these factors is one of the factors that we still give Malaysia GDP in the upgoing 4.5%. The downside risk definitely actually our economists think that outside is not our domestic anymore. It's more on the external side. So aggressive rate hike. If you know, last year we have a quite tough year in our equity, quite volatile year. Reason behind we have a rate increase rate cycle, which means instead of reduced interest rate, now is increased interest rate. So we call it a rate hike. So as for now, the latest Fed, US Fed actually start to stopping or just potentially reach to the peak. So when you have an inflation problem, basically the world central bank need to increase interest rate, and increase interest rate is not good for equity market. So if we have a unexpected aggressive rate hike again, then basically this is a downside risk to our market, slowdown in major economics. So basically you see a lot of headlines talking about especially US and Euro could be a hard landing, could be enter into recession. All this will be pose another downside risk. And the conflict between Russia and Ukraine started last year, February, March, like that. Tension between China, Taiwan, all this. But all in Malaysia, we are still okay. And especially Malaysia is a blessed country, I would say, because we're blessed by crude oil and palm oil. So basically, these two main resources, natural resources with high inflation environment, actually is still good because the price is good. So definitely, I would think Malaysia is still doing okay, and this year we onwards will be a good. Hopefully, it's a good year on start, and in January we start to seeing some volumes coming back. In terms of Malaysia monetary policy, as I mentioned just now, we are expecting 2023 is 3%, although the latest on January is unchanged, which means remain at 2.75. There still will be another potential with 25 basis point. Some of the reason is if other major banks continue to rate high, then we had to catch up as well. And commodity price is rise too much. If commodity price is accelerate too much, which means the inflation problem is still there, then we need to increase interest rate. And our inflation, if above 4% inflation, then we might need to increase interest rate. So all this. But the expectation is still maybe we are expecting around 3% OPR this year. Okay, so with LPR, so we have a ringgit outlook from economist team as well. For USD MR ringgit, basically this year we are targeting around 4.2 to 4.3. I know right now the ringgit is trading around this level. For our in-house view, potentially in the short term he will retouch at 4, but eventually our economists head still believe that eventually you'll go back to around 4.2 to 4.3 by year end. Fundamental of ringgit are still strong. Basically, economy grow again, 4.5% GDP growth, still expecting. Inflation. Our inflation, all this while actually is controlled much better than other country thanks to our government subsidy. With the government subsidy, basically we can maintain our core inflation around 3%, not until 4%. And our international reserve actually is still doing pretty well. We have a reserve of USD 114 billion by end of 2022. Oil price, as I say, we are a blessed country. Oil product is one of the main export product, and with the oil price trading around 80, 90, then basically with a high price actually is good for our ringgit, our national currency. And definitely the lastly will be the tourist recovery. As I mentioned just now, instead of our last year already seeing the interstate travel that boost our local tourism. Basically, if you look expecting the China is ongoing, reopening is ongoing, unless it go back to a zero COVID policy, then basically it's good for everywhere in the country, especially tourism. Tourism recovery will definitely be another boost to our GDP growth. So take a quick look on the chart. Basically, how to read this chart. This is a ringgit chart. So when this price going up, basically is a weakening trend. So until November last year, then I think US dollar start to peak. then our ringgit start to strengthening back. So when going down, actually ringgit is strengthened back, which is down back to 4.25. I would say it's in a healthy level. For technical wise, it's always have a stabilizing currency instead of just a wild swing in the equity market. Hopefully, we'll start to stable between 4.2 or 4.3 this juncture, or maybe strengthen a little bit further. Okay, for equity side, KLCI target, our equity side is target year end is 1630, back to a 0.5 standard deviation below his 5-year mean. This is underpinned by, again, stronger currency outlook. Instead of 4.7, now we are looking ringgit around 4.2 to 4.3. We still think our equity in the attractive equity valuation compared to a regional side. In-house GDP growth, we still think robust 4.5%. So with a 4.5% outlook, basically GDP growth, basically it's telling us unlikely we are entering the recession, at least for this year, and definitely will be better than US and Euro. And we are expect net foreign equity outflow to reverse, which means coming back to our country. Okay, the chart below here is a year to date, which means the January changes basically. So we are slightly down. Other countries actually pulling back, like Hong Kong back to 10.4%, Vietnam 10.3%, Korea up 8.4% reason being after China reopening. But compared to last year, actually they do pretty bad. We are still closing flat, just down nearly 3.something%. So naturally, we are quite defensive and resilient, I would say. Okay, one of the main catalysts, I would say catalysts in this year play is easing China zero COVID policy. What happened was last year is China have this zero COVID policy, which means among their state or their country, as long as there's COVID cases, they will lock down the whole city. So their one city actually is multiple times bigger than our whole country. Okay, so when this happens, zero COVID policy is locking down. Basically, it will cause the supply chain disruption. People cannot do business. Manufacturer cannot get spare parts, for example. So this year we see an easing, which means they're opening out and reopening after 3 years. So what we expect is basically we expect positively to most of our sector, okay, such as plantation. China going to get more plant CPO from us maybe, and this also boosts our Oreca activities, hotel, cafe, catering, all this. Then oil and gas also good because when China reopening, they start to redo the business. They need much demand from the crude oil because crude oil is the main commodity that needed for the worldwide. And banking, we are positive on Hong Leong Bank. Reason behind Hong Leong Bank has a subsidiary of Bank of Chengdu in China. So hopefully this will do quite good. All contractor basically continue better. First thing, construction problem last year is after MCO lockdown, they have an issue on the labor and also the material cost so expensive. So with the lift of demand, so hopefully this will boost out and push down the steel price, and eventually there's more demand on the construction work. And as for the port, definitely people can do business. Opening port is good for export. A manufacturer can export and import more stuff. Risk is good because as we see our local actually, even without China tourists, especially our inbound tourists, also I would say it's florist. If you go for the KL area, you go for the garden, Valley, you go for pavilion, then it's full of people. Okay, so risk is the one who are recover faster after MCO. Property has been downtrend for many years. So property, we think the beneficial will be IOI properties because they had exposure in China. Consumer, we like consumer, such as Berjaya Food with the Starbucks branding, Pardini, consumer staple, all the buying clothes, all this spending out, and the return of Chinese tourists. For automobile, we think positive, spare part component changes, the chip and shortage, component shortage is going to be eased. The supply chain disruption is always a supply chain disruption for these 2 years. It's getting better. And healthcare, we also think positive. For technology, definitely, because last year had been a good correction. It's not only because of our increased interest rate outlook and also supply chain problem, supply chain disruption. If you go to see all the company, tech company, they say sometimes they're quite hard to maintain the supply chain. And transport will be positive. Malaysia airports has because of reopening of border from China international border, and EMS we also think is a positive. So all these main theme will be back to easing China zero COVID policy is a main direction that we should look at for this year. Sector wise, most of the sector we like automobile sector. Automobile is quite paying good dividends. Cars number is never drop. It's been increasing, even though the sales tax is start to slowing down. And banking also is very defensive. Especially last year, we had increased interest rate, basically boosted their earning outlook. And this year, we still think our banking analysts still think it will be beneficial because the valuation is not expensive compared to the sector. And this year onwards, we don't have the Chukai Mamut anymore for the bank stock. So in terms of defensive, even though dividend stock, actually banks is still the right place to look at. Manufacturing sector will be positive as well, such as Encom, Linex, all these because of the tension between China and other. Over the longer term, we think is still positive on manufacturing. Media will start to seeing some attacks, which means the advertising expenses start to coming back with a strong growth. For oil and gas, we think definitely it's good because oil price, no matter how, is still doing around $80 per barrel. So technically, it's still positive in the longer run. And it's not like crude oil price doing $40 or $50. In fact, this year, Petronas increased back their capex. So Petronas usually is the most important indicator to our local oil and gas counter. So when they increase capex back to a pre-COVID level, basically they are giving you more job flow to the industry, to the segment. So all this is a positive overweight. And ports as well, power as well. And property, we think graduate recovery. Actually, property have been trading downtrend for multi-years. And right now, hopefully, our analysts think that is valuation is there, is a value. So can start to looking at. And REITs definitely is good because I say shoppers is coming back to all the shopping mall, the main shoppings, REITs. And REITs usually can distribute the yields more to like 6 to 11%. So our top buys are in terms of banking, we like IHB Bank, CIMB Bank, and also Bank Islam, the main one. And power, we like the Naga National, the market leader. Oil and gas, we actually like Inson Holding because it's very strong in FPSO player, floating production, storage, and offloading player. Is a very quite niche, but near to mid to upstream player. They modify their whole ship and then they go and collect the oil and sell the oil, something like that. Okay, we call the FPSO player. We also like Dialog because of very quite defensive because of tank. They are doing tank. They're also doing a little bit upstream. And in terms of REITs, our REITs we always like Subway REITs because it's very diversified. They have a retail mall, hotels, office, university hospital in the portfolio. Some of the small cap idea is in terms of manufacturing, we like Encom Linex. Transport, actually we still like Para Transit because they're doing very resilient. For oil and gas small cap, actually we pick Dilem. Dilem is a return of because previously they have the suspension from the Petronas standard, but right now already lift for the latest quarter. So hopefully in the near term, in the mid to near term, they can get more project from Petronas. This is one of the key catalysts I would say for the stock. And in terms of auto, we like MPM Resources because Berdua is still doing very well. And healthcare, we like Apex Healthcare for all the small cap ideas. And this is our dividend news stock. Basically, most of the stock is still under the REIT sector. As I mentioned just now, REITs actually provide 6 to 11% dividend. Okay, sector view. In terms of last year performance, this is until last year December, right? As you see, first we compare the big cap and small cap. And basically, both of them is not doing very well. Sorry, just 1 minute. Okay, so KLCI actually down 4.6% last year, and small cap actually down 5.3%. So not really have a direction, have a gap, then you can go in. And last year performance, the best is still energy. year-to-date up 10.27%, and followed by plantation 8.13%. Then financial, because up cycle interest rate is up around 6% as well. So basically, I'm telling you that in terms of resources, commodity, we have two resources, which are energy and plantation, usually doing good. This is for last year, okay? Let's see this year's what happened. This year, KLCI, which means the big cap top 30 counters, year to date is still down likely around 0.67 until end of January this year. In technically wise, is still in the sideways in between 1460 and 1500, and bigger we have 1530, bigger sideways trend. But in terms of small cap, actually it's quite interesting. Year to date, actually small cap index already up 8.29%. So technically from last year, we already mentioned if there's a breakout from this so-called classic double bottom pattern, which is 1450, usually they will have a technical breakout. And seems like the recovery is quite strong. Even the December, there's a pullback in the December, but in January 2023 this year onwards, they surge. So year to date for small cap, 8.29%. From here onwards, then we can pretty tell us that instead of investing in the large cap, actually you should start to look at more on the small to mid cap stock. Okay, small cap actually is up to 2 billion market cap Malaysia, and up to 2 billion to 5 billion ringgit basically is a big cap. This is how we define small to mid cap stock. Plantation, sector wise, mostly energy leading another gain. So 14.31% this year. So we basically see most of the oil and gas counter is a mover for this month, and followed by transportation and logistics, basically the airports, all the transport, because ever since China announced that they're going to reopening their international border. So the business is coming back. Most of the sector, not like last year, if you see, is turning to the positive. Healthcare is still down 3.72%, basically telling us that because healthcare sector in Malaysia actually included the glove players. So glove player might need more time to consolidate to settle down the whatever that the market share is left. And technology also up around 6%, property up 6%, construction 5%. Another I like is definitely consumer, very resilient, is still up 2% as for now. Okay, as for finance, this year is going down slightly 0.53% as mentioned. Finance definitely is still the defensive one. If you are the dividend player, look for stabilizing investment grade company, definitely banking stock is still ideally, but right now it's doing sideways. And potentially you have a inflation peak outlook, which means potentially we are not going to increase interest so aggressive anymore, then basically they will start to stabilizing for finance, but it's normal. In terms of fundamental view, actually, when I still project 2023, core earning growth is still up 8.4% compared to last year, 13.8%. This is supported by high net interest income and lower provision for loan repayment. And as I mentioned, 2023 will not see a repeat of a Cukai Mamuk like the previous year. ROE for this sector, basically 2023 still expecting 11.2% compared to last year is 10.8%. Our topic is RHB Bank, CIMB Bank, and Bank Islam for the second smaller cap of banks. Okay, next one is the energy. So you see December there's a movement start to move, and there's a pullback, but ever since it break out from this flat pattern, is so-called flat pattern indicating a continuous movement. Basically, you see 2023 is a strong growth in our energy sector. Year to date up 14.31%. January, the small cap index contributed by energy sector, one of the main sector that driven, as I mentioned to you. Potentially people see that even though it's potentially we are in the peak, but the crude oil price is still doing around $80 per barrel. And also China reopening, the business volume might continue to robust, continue ongoing. So the demand for oil products, petroleum products will continue to rise. Okay, we overview on the sector as well. As I mentioned, we anticipate further domestic job flow, and Petronas have really increased our capex allocation. For local oil and gas, it's not hard to see the direction, because we have a national company option to 500 company in Petronas. So whatever it is, every year Petronas will have a capex outlook. So if the capex is going good, which means indicating that they're going to give more jobs to our local listed oil and gas counter, and remain $80 to $90. Our top buy again is Inson, Dialog. Then we have a dividend play on Petronas Gas, the stabilizing one. Then we have consumer products. Consumer product actually is doing quite good, especially China reopening breakout and eventually start to stabilizing here. So overall, I think it's still positive for consumer product, especially those their earnings coming back for the last year, and hopefully this momentum will continue to rise for consumer product. We have a better prospect in 2023 because of improvement in the fundamental economy that can boost the consumer spending, like improving labor market, higher wage growth, continued expansion in the retail sector, cost to come down. So last year, most of the consumer sector and the manufacturing sector also facing the problem is they have the cost problem because of inflation. While material cost actually very expensive. Hopefully this year we start to see is going lower, trending downwards. So the cost to come down, then they can easily have a better margin for their business. And our top buy is Berjaya Food because of the Starbucks. We also have buy in Kwan Chong, Mr. DIY, and Leong Hap. Okay, in terms of industrial product, basically also in the early stage of recovery, technically, break out from this line. And construction also similar trend, early recovery stage. Generally, I would say we are doing pretty okay on this early of this year. And property is if you take a longer view for 3 year, actually it's still trading in the 3 years trend, downtrend. Okay, and 3 year downtrend basically is still, however he returned, the recovery could potentially only treat it as a very early sign of recovery. So however is it, but it's still up 6.03%. Fundamentally, we think the valuation for the property right now is cheap, but downtrend remain intact for property sector. As for plantation have a good rally on last year February, and May has eventually erased most of the gain. The reason behind is they have two issues. One is labor, the other one is cost. Cost from where? Fertilizer. Fertilizer is so expensive until they actually erode most of the planter margin. So that's the reason now plantation counter now is a sideways. They are still making money, but in terms of growth, they might need more time to settle the labor problem and the fertilizer cost. So overall, we maintain sideways view on plantation. As for technology, actually technology has been a good collection until last year, and this year, last year is starting to have a sideways. You can continue go up from here, then coupled with the increased interest rate outlook going to slowing down, then basically it's good for growth stock like technology. And in this month, we actually start to seeing some very early recovery sign from the technology. Hopefully the momentum can be sustained. I would say it's not going to be very easy like the year before or the mega trend, because we're still in the increased interest rate outlook. So when you have an increased interest rate outlook, it's never good for technology. Okay, it's never good for growth stock, definitely, because you are increasing their borrowing costs, and they need a lot of money to expand basically, and they always have a cyclical. But right now, the moment of this technology is they are in the very early stage of recovery. Okay, but for my view, is unlikely to be a strong V-shaped rebound. Okay, not like a COVID time. When COVID time totally locked down, they have a sharp correction, but then after people start to decrease interest rates, stimulus the market, then they have a V-shaped rebound and strong growth. Okay, right now Fed is going to take their step. US Fed is going to take their step to see how to monitor the inflation, but they cannot lower down the interest rate immediately. So I would say, for me, I think because of China also reopening, supply chain disruption, this problem is slowing down. So I think technology will recover part of it by a slower pace, because eventually technology is still will recover because the direction is there. EV is here, renewable energy is here, everything you need is chips, everything. So but in terms of making money from stock market or investing, then it might take some time. There are a lot of good fundamental technology stock in Malaysia, mostly in Penang, I would say. So they will start to recover in my view. Healthcare, I think it's still challenging. After a sharp downtrend, they start to recover, but most of the time when this kind of major trend, they will start to turn sideways. And this sideways could be very long and very a little bit volatile. You never know where's the resistance, where's the support until they finish building for some time. Reason being, logically thinking, after a sharp sell down because of oversupply problem, they really need time for the market, for the players to solve the problem. Okay, when you need to solve the problem, then you give you a sideways trend. That's it. Okay. And transportation, logistics actually doing very well, especially a breakout from here. And we see it's a positive momentum because of reopening. Our top buy is Malaysia airports, then followed by Westport. Okay, let's talk about a little bit about our stock idea on the fundamental coverage. Okay, first one is we look at MCOM 9X, one of small cap idea as well. So MCOM is do what? Basically, they are pioneer in the manufacturing of agricultural chemicals, or we call it the agricultural chemical, we call it the AgriChem, such as herbicides, all these kind of chemicals they use in agriculture. So eventually, MCOM business model, if last year you follow, they should take over everything from Nylex. Their chemical in the chemical division. So they're going to become agri-chemical manufacturer conglomerate, and with a wide range, including industrial chemical, polymers, and logistics. So the main thing is still the agri-chem division, because agri-chemicals, agri-chem division is the only large-scale manufacturer in Southeast Asia, especially we call the active ingredients, AIS, active ingredients for the herbicides. Basically, herbicides need to have a different herbicide for different crops. Okay, for example, you plant crop, you plant coconut, or you have a very different herbicides. Okay, and this need different kind of active ingredient. And there also has been a major operator in Asia Pacific, one of the largest. They serve domestic market and export over 40 countries. So right now they consolidate. Okay, they want to become a agri-chemical and also industrial chemical player in the region, one of the biggest. So we consolidate all the non-chemical related business to achieve greater division, economy of scale, and cost reduction. And recently they also have an acquisition on this non-animal health and wellness. So they want plan to solidizing his leading position in AgriChem by providing an integrated solution across the fruit supply chain. So basically, because this agriculture chemical will affect the fruit supply chain, because wherever you plant your soybean, you plant your crop, you plant your corns, you need a proper herbicides to control the yield. So they are pioneer, they are the leading position here. So they are very expertise, and comparing to other players, they have been in the industry for so long. So they want to producing new active ingredients to do all these herbicides. Basically, they actually need much lower capex compared to other players. And recently, we have the ban of paraquat in Malaysia, Thailand, and Brazil. Okay, paraquat actually is one kind of a toxic chemical they used to use, but it's very toxic. That's why there's a ban. So when he banned already, basically, this is an opportunity for Econ 9X to intro a new agriculture AI, which means the active ingredients to further boost their company earning. Because the one is some of the reason is the one is increasing global food demand, population getting more, so food controlling the global yield is pretty important. So basically, they are benefit on this, and they also have a strategy, a multinational China plus one strategy, which means it start to find out ever since a lockdown. China also locked down until now only reopening. Actually, their customer try to find alternative AI supplier outside China. So this is one of the benefit. Okay, just like a technology side, they try to have a second choice. Okay, put it outside China. If China cannot produce, then might look for other suppliers. So this is a benefit of income line next. So overall, we think in the short to mid term, we still have growth. And our list, in terms of chart wise, technical wise, has been a rally since 2021. This called a major uptrend. Then on last year March, they start to have a correction, which is a healthy one, nearly to 50%, but eventually it start to consolidate. And until lately, it start to break out, indicating the demand of the share price coming back, or people still think positive of the company prospect. So the key side is here. In terms of this kind of pattern, we call it the 3C, okay, cut completion pattern. It's one kind of low chip patterns, which mean they're indicating the major uptrend actually is still positive in the potential is still positive in the longer run. So let's see how time to time you will start to pull back and build base is normal, but overall we are looking at it positive. Next one we like is Quan Chong. Okay, Quan Chong is not a chocolate player. Okay, Quan Chong is the guy who do the chocolate ingredient like cocoa liquor, cocoa butter, cocoa cake, cocoa powder, and they are one of the largest in Asia Pacific. Okay, so basically they will plant the cocoa and produce it to the cocoa powder, cocoa cake, butter, then sell it to the upstream players such as Kit Kat, Nestle, Kit Kat, Hershey. So they provide this kind of ingredient. It's been down a correction mode and sideways in the last whole year. But right now we see the recovery demand for upmarket chocolate. So in order to boost their ingredient price to go up, you need to have the demand for your Kit Kat, demand for your Hershey chocolate. So when China reopening, basically, especially Euro country, they will beneficial there. We are looking at a recovery from tourism and hotel industry. We expect the demand for the luxury segment, they will pick up. So when they pick up, usually you boost well for the cocoa butter ASP, average selling price, and then Quan Chong will be a beneficial. Quan Chong has been the international expansion plan is ongoing, and this year actually completed in Ivory Coast near to Africa. New plant was commissioned, so expect to add extra 60,000 MT for annual grinding capacity. So they talk about a grinding capacity. So the bigger they can grind more, so they grind the cocoa to become the ingredient like liquor, butter, cake, for example, existing around 270,000, and right now with the 60,000, so now Quan Chong can produce 337,000 MT per annum a year. So this could lead to contribute another 18 to 90% of the company EBITDA. And also in Germany, the Euro, they also complete the upgrading the plant, so add around 10,000. So the analyst downside risk is on the Germany side. Reason behind is Euro, when you grinding, you need a lot of electricity. Electricity basically in Germany is very expensive right now, energy, especially because of ever since Russia invaded to Ukraine. So cost the whole Euro energy usage is very expensive. Natural gas is also very expensive. So this a downside risk to drag a little bit on Quan Chong. But overall, we think the EBITDA for Quan Chong will continue to improve because fresh rate finally going down. So customer willing to ship more, especially China recover. And ASP recovery boosted by demand. As long as the demand is recovery, people going to buy more chocolates, basically you benefit from them. For Quan Chong, they have never stopped the overseas expansion plan. They're still ongoing, even you are in the COVID time, you are in the inflation outlook, they're still expanding, and eventually the major expansion actually just done this year. So overall, we still think it's cheap in terms of valuation, and in the longer run, we think it can doing much better. This is one of our buy code as well. So it has been downtrend last year, and 2 years ago started last year has been sideways and until recently recovery. So all this kind of chart is not like your technology stocks are one way straight out, not your new IPO stock one way straight out. Okay, it's more on the fundamental view. It's more on the early stage of recovery. They have a proper recovery, proper management to all this. For the longer term, actually has been sideways and potential to post more positive in the near term for Guangzhou. The next one is a Panda Master. Okay, Panda Master is a tech stock. Technology have a rough year last year, I would say. Year to date last year down already 30, if not mistaken, down collected almost 36%. But this year we start to see the light of tunnel. So indicating that most of the technologies start to have an early stage recovery, as I said. So Panda Master is our pick as well. What they do, basically they do ATE, automatic test equipment. In Malaysia, for the semicon players, actually we are tagged in the OSD and test player ingredient. So the whole supply chain, they have the frontline design, then manufacture like TSMC, then only OSAT, which means like in those player outsource semiconductor assembly and test. Then OSAT player will purchase test equipment from this kind of player we call the ATE maker. So they make the equipment, then test. That's why you see your smartphone, whatever your iPhone, Samsung, your whole screen will never light out or something like that, because they need to go through the test, and this kind of test you eventually you need more because your EV is coming in, everything need to be tested, and more 5G is coming and it's more sophisticated needed. So Panda Master has been doing pretty well. We start to seeing robust demand for the automobile industry. EV is a price stock for this year and rise on the we call a vehicle electrification. When your whole car going to electrification, basically you need more tests. So this already expected to contribute more than 45%. Not only that, for Panda Master, actually order book already exceeds 500 million. And they have another sector, which is the FAS, Factory Automated Solution, actually gain momentum. Among this 500 million, actually 40% start to coming from this Factory Automated Solution. This gives them another boost, and the remaining 60% remain at the ATE, their main sector. So electro-optical demand is still expected, even though iPhone is slowing down, but eventually they keep upgrading. They also need their better equipment to match back their better version of your smartphone, your light bulbs. And Panda Master also have a medical device, but it's still pretty small. But this year revenue start to break up, Q on Q up 1.1 time, year on year up 2.9 times. Over the long run, could be the next driver, but the main driver is still FAS and AT, automatic test equipment and factory automated solution. So in terms of Panda Master itself, actually portfolio dimension is quite large, quite good. So they serve more than 100, 200 customers in different market segment expansion, and they continue to expand their customer base, which is very good. And growth in factory automated solution, supported adoption of Industry 4.0, and robust automobile offering supply from the front end and back end customer also. So technically, they are doing pretty well, and it's a well-managed company, I would say. Share price been corrected together with the Nasdaq, together with our technology sector, but eventually it start to have a early sign of recovery this year. I would say breakout. Time to time, I would say they will build base, continue swing, but in the longer run, they will positive. And this is in line with their peers as well, which means they are rival. So we see a sector momentum. For other ATE players in Malaysia, we have the market leader actually is Vitrox Corporation, then Panda Master Corporation, MI Technovation. Then we have a smaller players such as QES Group. All these are actually an Emulus, AEMU, Emulus. All these are test player. So you start to seeing a momentum for the Vitrox and Panda start to recover. So indicating that there are more positive signs, especially for Panda and China and Vitrox, they are more exposed in China. So in China, because Panda have a subsidiary listed company in Hong Kong, and Vitrox have a lot of customers actually come from China. As well, this in line with China reopening, they need to bring back the business volume, business activity, then they will recruit, they boost up their demand in the near term, at least this first half year in our view. Okay, moving on, we have the stock on the move, some trading ideas. So actually, stock on the move is our another product for retail research from retail research. So retail research, we have a daily product called stock on radar, and we have a weekly product called stock on the move. That's invented by me. Okay, so stock on the move, some of the idea that I realized to look at. First is Bonia. I think Bonia is good. Okay, what is Bonia? Basically, they produce luxury products. Their product is including design, manufacturing, marketing. Okay, for the past few years, from my understanding, actually Bonia carry a lot more brands, okay, and licensed brands, in-house brand. But right now, I think the group now is focusing in Bonia himself own brand and also Braff Waffle, another brand. So these two, especially Braff Waffle, actually SSG, same store sales growth actually is doing pretty well as far as my understanding. So they are focusing more on these two brands and they take away other brands, for example. So in terms of Bonia, actually they are focusing on 6 growth pillar product line extensions. For example, they launch a new product because they are a designer brand called La Luna or this. So they have something fashion and designer. And in fact, in Malaysia, is very seldom we have a luxury brand. Okay, because branding is something that is very hard to build. So I will give that for premium, more premium. For example, like you very hard to build a LV, you very hard to build a Gucci. So Bonia is our local brand is doing pretty well, and they also continue their strategy on a brand partnership collaboration with social those KOL to promote, same as other main brand, and store enlargement and enhancement. So they're more modernization their boutiques. So they start to renovate. They also focus on e-commerce expansion, digital enhancement, talent management, all this together. But what I like is usually I pick the stock with my own way, own style to analyzing. Is usually I look at quarterly and annual. Okay, I want to find out what's the earning momentum trend for the company. So the latest quarter for Bonia is the first Q FY23. Basically, I'm looking at the year-on-year growth for their earning per share, which means the company earnings and also their revenue. So usually I look for the company their continuous momentum built more than 20 or 25%. They will be the ideally. So you take a quick run on latest 4 quarters from 2Q FY22 to 1Q 23. Actually, year-on-year compare their earning actually is up tremendously, I would say. 180, 332, 21. So as long as 25 to 30%, I will assume it's growing already. Okay. And in the same time, we also try to take a quick look on their revenue, also grow together to 35, 37, 93. So it's a healthy growing for the 4 quarters. So this thing you tell me that earning momentum actually is still there, which is better to help you to filter out investment grade company. So consider investment grade company. Then we take a quick look on annual as well. Also look at their earning per share, just a basic earning per share. Number is not so important. You can pick from the. For me, you can just pick from the annual report. Everything is have to pick from the annual report and quarterly report, and you need to see the trend itself. So I don't only focus price trend, but I also focus on company earning momentum trend. This is what I do. So for Bonia, actually 2018 start and 2019 is earning per share total is around 8-9 on average, and 2020 is understanding because of COVID lockdown they dropped to 1.41. But 2021 actually the full year of 2021 they actually back to 7. So on average, they have 8 to 9. 7 actually is a strong recovery, up 405% compared to a COVID time. And the really highlight is last year. Last year, they total make another 200% on make it to 22.39 earning per share. So you compare this 5 year, basically this is what I call is a breakout year for their earning per share, which is a key signal. So overall, I think most of the company will be announced their quarterly result in February, end of February. Let's see how's ongoing. Hopefully, next quarter will be also more than 20-30% growing. In terms of trend itself, actually, he's been doing very well. So the earning momentum trend give him the share price from 1 ringgit surge to nearly to 260, 270 on the year before. Then they have a correction, which is a healthy correction, and sideways until recently go back to the previous high, indicating another technical sign for us. Will it be continuous going? We don't know. Hopefully it is. But if the earning momentum can keep up going, then I think there are more upside for Borneo. Especially personally, I will give higher premium on their branding. As I say, luxury brand is not easy to build out, and I can't see other really significant local brand that make it. So let's see how. So technical already point time to time they will pull back, but as long as we call the major primary trend is still sideways, you see, when you measure uptrend up to 200 more than 200%, they start to build sideways. It's normal. It's a huge pay for last year April until this year. So if you are longer term investment or even you want to do your timing, you might need to spot where to identify. But overall, I think they are positive. Fundamentally, they are doing positive as well. Okay, lastly, I have the SDS group. Okay, SDS is a very small company. What they do is they're manufacturing and retailing bakery product. Okay, bread like top. Their brand is a Top Baker and Dailies. They also have cafe called SDS. They are home based mostly in Johor. So unlikely you will see in KL right now. And Klang Valley, I would say Klang Valley, I checked, I think it's Bang Yi only have one, but mostly in Johor. But their sales is doing pretty well, and they are expanding to this, continue expanding to other states. And this is a distribution center for their bricks, dailies, and Top Baker. So are getting more and more. Actually, most of the Peninsula Malaysia, they already start to start to distribute their brick manufacturer as well. So now it's still the ACE market, but they already apply to transfer to main market, and still pending announcement when they're going to transfer, pending on SC approval. And they have a retail segment, they have a wholesale segment. For the retail segment, basically, it's SDS Cafe itself. So last year they have a good run because of reopening. People start to revenge spending, we call it. So the interstate travel, they actually boost, especially people from Singapore go to Johor. They really boost their cafe business. And time to time, the R&D also intro new F&B offering to meet customer taste. Then wholesale is, like I say, is a logistic fleet across Malaysia. They start to expand more distribution center. Now it's already covering 10 states in Peninsula to produce more, to distribute more on their Top Bakers and Dailies brands bread. So they have separate retail and wholesale again. Same if you look for the earning momentum trend, latest last 2 quarters actually also up. So you need to compare year on year, which means second quarter FY23 compared to second quarter FY22 actually up nearly 12 times, 10 times, 6 times, and 77%. So he's been growing strongly, getting stronger. Revenue also growing stronger. So this company actually listed not long. So only have so far can only find 3 years. So 2002, I would say is the COVID year, one of the worst year. It's doing 1.21, but from 2021 they start to recover it up 44%, and 2022 they're up another 47%, and right now already announced 2 quarters. First half of FY23 financial year, actually they already achieved 3.23 earnings per share, and this is already more than last year whole year for 23%. So if not mistaken, another 2 quarters onwards, then they can have whole year, they can also up around, go back to around 40%. So all this is earning per share is growing, which means the price trend is uptrend, earning momentum trend also is uptrend. So these are ideally they are looking at. Okay, in terms of price trend itself, it's been up. Yes, an initial base breakout from this is near to 50 cents, but right now it's trading about okay. It's still okay to invest because as long as we call the stage 2 trend or the uptrend, because you need to know how to count the base. Okay, for us really start growing stock, from my experience, so they usually have at least 5 base. So this is an initial base, which means when they break out, there's only first base. And time to time, it's just like you're climbing mountain, okay? When you're investing from technical view, you're climbing mountain, you will need to have a break and build base, build base. So in terms of the signal rise, actually, they are still in the quite early stage, I will say. This initial base breakout, then followed by this is a second base breakout, and now is consolidating. Time to time, they might have some correction, forming a third base. So third base eventually is I would say it's still considered as a safe entry point. If you go on to a 4 base or 5 base, then you bear much higher risk, because we will never know how far the company can grow. They can grow much bigger and making more profits if they're doing very well and they execute their plan very well in the longer run. This is how we monitor. So ideally is look for the uptrend. They also uptrend in their company earning momentum trend as well. Okay, disclaimer. I think that's all for me. Thank you.
Thank you, Mr. Liu. Now we will start the Q&A session. So feel free to drop your question in the chat box here. Okay, Mr. Liu. You there?
Yeah.
Yeah, the first question is what is your opinion about PTRB?
Actually, PTRB is a PT Resources Berhad listed not long company. And actually, I already wrote a piece on PTRB on stock on the move last year. If you curious, actually, you can read about it. I think it's positive. First is in a major uptrend. Secondly, they are doing frozen seafood. So they are expanding to the e-cost. They also have the company, they have the branding called MO, if not mistaken, MO signature. So most of their business actually driven by China. So when China reopening, basically their frozen seafood can produce, can ship more, can export more to China, indicating there are more upside. In terms of earning wise, 7 million, 8 million first 2 quarters. But because of new listed company, then we have to see it could be more volatile, but overall I think generally is positive. Yeah.
Okay, next question is any reason you have placed MBSB in the buy category?
MPSB in the buy category. Okay. Okay, MPSB is a Malaysia Building Society Berhad, right? That one is under our financial. Any reason you have placed? No, I didn't place any buy in the buy category. But in terms of fundamental, I think this counted more on the dividend play, financial planning. So I think it's still okay. Tourism potential for China tourists. Which country can benefit? Basically, I would say the worldwide can be benefit because China tourists usually go everywhere in the worldwide, and we call them they are the high saving citizen, which means their saving rate much higher than other country nation, potentially higher. So they really can spend. And which counters can be benefit? I would just mention to you, Borneo, or some of the branding in like Malaysia in nature also. Okay.
The next question will be about the focus point and Optimax.
Okay, focus point, I think the share price really quite stiff, quite strong. So focus point actually to focus on two kind of business. One is a focus point, of course, the spec. Tourism coming back could be boost the sales. Another one is a Komuji. Komuji brand, which is the brick bakery, is under them as well. So this is a potential they are beneficiary. But focus point share price are a bit illiquid and uptrend has been strong. So I think in terms of technical view, it is better to have a pullback or build base. Just I mentioned to you, you need another base that only can generate a new entry point for you. Right now is a point from technical point of view is a purely near-term overbought situation, but doesn't mean he won't continue to go up because most of the time stock they are in a strong uptrend, strong growth actually is really overbought all the time, but the timing is not there. Optimax basically is quite good because a health niche player in the healthcare, they do eye specialists, and now it's a sideways build base. If there's a breakout, then it's a continual movement. Now it's just resting. So I think Optimax is okay. They are keep expanding to a nationwide. We also write a piece on stock on the move as well. And we like it because it's quite niche. It's just like a Sengyu Medical as well. It's a niche healthcare player.
Okay, this question from Daniel. What your view on the Econ Berhad and ENO?
Okay, Econ Berhad basically Econ Berhad it should be a compound, right? So you have to wait for the return back from the job coming back to a construction, put it that way. And ENO it's not under our coverage, so I couldn't comment much. And I will write a piece on ENO as well. It's just about the property players. So in terms of property, actually you need to see a full recovery.
Okay, next question will be on the comment on the MHP.
Okay, in terms of NHP, actually NHP is generally positive together with all the smaller cap in oil and gas counter. So they really, just I mentioned in the sector, actually is start to recover. So it's not only NHP, it's the same trend as like Dayang Enterprise, Costan Contract, even Pertana Petroleum. At the latest, we have the Relaxation Energy, Bumi Armada, they all rally together. So I think the sector have a momentum. There are benefit in the near term. As I say, crude oil price is still around $80. They still require. Yep.
Okay, next one is a 3R Resources Berhad.
Not much comment on 3R Resources. I think the market, the share price is still trading in the sideways. And Enfla target price one is reasonable. Yes, because everything that we write on AmInvestment research, we have to have a reasonable point to bring it out to factor in what's the fair rate of 1 ringgit. So the detail you can go through the report on Enfla why sitting is 1 ringgit.
Okay, next one will be the Maybank and Gadang.
Gadang prospect going to be the same as construction, and Gadang is more on a smaller cap. So construction, for me, I think construction sector actually is still need time. Honestly, it still need time for them because they have two issues. One is a labor issue, another one is the material cost is still expensive, even though they are slowing down, coming down from the peak, but they still need to manage, need time to recover, put it that way. Maybank is a buy. Is a buy just a financial dividend stock, and they pay good dividend.
Okay, next two is the Genetic and PChem.
Okay, Genetic will be a more on main customer actually is Tesla. So mostly Genetic mostly such as a EV player. If a EV player can recover far, then Genetic potentially customer can grow better. And PChem basically is positive because of oil and gas. QAS already mentioned. QAS basically is same as all the ATE player, Panda Master with trucks. So yeah. For Genting Malaysia, basically Genting Malaysia is still in the sideways trend, and unless we see a strong breakout, then Genting will go higher. MRCP will be a construction. I think need more time to consolidate. Yeah. Okay, I think
investment, Padini, P Metal, and QL.
okay, for Padini, okay, just now also mentioned some people like Padini fundamental compared to Borneo. Basically, Padini is stabilizing, and personally, I think the valuation is expensive. And Padini actually is doing very well, and in terms of dividend player is good. Press Metal and QL is recovery. You see, because QL is the main market leader in consumer sector. You see consumer sector start to recover, QL resources will go out as well. And P Metal has been doing pretty well, especially China reopening. I think the aluminum requirement or the demand for aluminum products getting more. Good dividend paying stock, actually just mentioned most of the risks we like. We also like Astro. Commodity price is going up. Okay, for commodity price, actually, could be going up, but eventually he will start to slow down because increased interest rate, you start to stabilizing and controlling the commodity prices. Okay, I think I just take another 2 more questions. Okay, Great Tech, I think Great Tech is good, similar like Genetech, also a service player for EV players. And Scientech is a very stable company. They have 2 segments, which is one is the plastic continue to expand, another one is affordable house. So Scientech is always the very stable company. Okay, I think that's all.
Okay, all right. Thank you everyone for attending this session, and thank you Mr. Liu for sharing the valuable knowledge with the audience. If you wish to get the research report, update or future event info, please join our Telegram channel, which had the link posted in the chat box. Again, we would like to wish everyone 新年快乐 and happy Taipei Sunday. See you all in future event. Thank you and bye bye.
Thank you. Bye bye.
Thank you. Bye bye, Mr. Liu.